NFP! FXStreet! FXStreet! $202. It's going to be an interesting day. This is royalty-free music, YouTube. All right, we're almost there. Almost there. Yeah. All right. Good morning, everybody. Welcome to FXStreet. Trade non-farm payrolls live month 202 in a row. If you're trying to add that up, yes, I've been doing this live stream with FXStreet for about 16 and a half years, every single month in a row. That's probably longer than your last guru has been alive. So thank you to FXStreet for being a wonderful resource for retail and traders of the foreign exchange. My name is Wayne McDonell. I've been doing Forex, I guess, personally for 25 years, professionally for about 20 years. So I've learned a few things along the way. I started with quantitative analysis, and then I worked my way to technical analysis. Traded for many years, and then in my 40s decided to go to Harvard to get a bachelor's degree in macroeconomics and a master's degree in financial management. Then I went to Harvard Business School to study venture capital. Then I went to MIT to study cryptocurrencies. And then I went to Oxford to study algorithmic programming. But besides all that, I still have plenty of things to learn. I have lots to share. So I rely on you to ask questions. I need you to participate. So let's do it this way, participation. I like to plan trades in advance. I like to look at global macroeconomics to set a bias. I like to use technical analysis to enter and exit trades. So it's strategic and tactical Forex trading. Oh my God, actually that's the name of my book I wrote 12 years ago. You can find that on Amazon.com. I am writing a series of books right now called Bulls and Bears on technical analysis, Hawks and Doves on monetary policy, and Angels and Demons on about trader psychology. So maybe in the next 10 years you can buy the box set. But right now I do all of that for fun, Robbie. Keeps me sharp, keeps me focused. Let me remind you that trading is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. However, please always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Looking here at the Non-Farm Payrolls preview on FXstreet, we see $1.85 is the consensus. Last month was 223. Now, I think we should probably look at revisions. Probably going to get a lot of revisions today. Also, the market is hypersensitive after the FED, BOE, ECB. There's a lot going on. And we're trying to figure out. Okay, we're trying to figure out. Right now, what's priced in the market is one more rate hike by the Fed, and then by November, one or two rate cuts. Do you think that's right? Or do you think there's going to be two more rate hikes? Do you think there's going to be a rate cut at the end of the year or no rate cut? Well, that's how or where today's NFP fits in, because past non-farm payrolls were really not that important because we already knew what the Fed policy was, jack up interest rates. But now the market's trying to figure out what is the terminal rate. So you might have caught that discussion in the press conference that Jay Powell did 2 days ago. So what is the terminal rate? When are we going to hit the terminal rate? How long are we going to pause? Are we going to pause for 3 months and then cut? Or are we going to pause for 3 years? Okay. Robbie says, hey, I only have a law degree and a psychology degree. Very cool. That's very cool. You probably understand people very well. You probably remember names very well too, which is good. Now, Don says, yeah, the market is wrong, sir. Too optimistic about the rate cut. I'm a believer on that side, but it doesn't really matter. We need the research. So what I thought we would do today is try to figure out if this $1.85 that the consensus has is right. Very often, most people are wrong. So if most people think $1.85, well, it almost can't be true. So why don't we start breaking this down? ISM, I thought we could start with ISM. And let me, do I have a spreadsheet somewhere? Let's do a blankie. We'll do a blankie. Okay, so let's do ISM services, ISM man. Let's look at weekly jobless claims. Let's look at NFP. Let's look at, we can look at Jolts. Challenger, Christmas, and Gray. We could look at ADP. Okay, and let's just do sort of like, based on what we see in these trends, let's do higher or lower than consensus. Up or down, good or bad. Okay. Robbie asks, hey, do you have to know quantitative analysis and fundamental analysis, or can we just make money being technical analysis? Okay, look, dude, Robbie, if you want to be a professional in this industry, why would you say, I don't want to know why the market's moving or how the market's positioned? I only want to look at charts. It just doesn't make any sense. You would never be a professional. It's an amateur, so anyways, like, why would you not want to know? I mean, but I get that question a lot, but it just comes down to like, why would you not want to know? Okay. I'm not willing to put in that kind of time or effort to be. I mean, look, if you're an expert in anything, you want to know everything. Am I right? Let's say you want to work on, you have a love for Mustangs. Not the horses, the cars. So if you spent 10 years working on Mustangs, at the end of those 10 years, you should know everything about everything. Okay? So if one day you were walking around at a car show and someone's got a Ford GT500, let's say in 1967, you're like, oh, Eleanor! And you go up and you could have a 2-hour conversation with the person who owns it. But you also know a lot about a 2005. You might not have a love for a 2005 Ford Mustang GT, but you'll know the difference between a billet and a regular GT. Okay? So anyways, it's just, you need to know everything, Robbie. Let's just put it that way. If you want to be a professional in this industry that we call Forex, you need to know everything. Oops. Absolutely everything. You should smell of Forex. You should reek of Forex. You should eat, sleep, dream Forex. And if you can't do that, you're going to get whooped and beaten down by someone that does. That's my opinion. So I've been doing this now, like I said, probably for about 25 years as a professional, more than 20, and I am hungry for more. Okay. So anyways, that's that. There's my opinion. You got it. So anyway, so what I mean is H or L, higher or lower than the consensus. So the market thinks, according to FXStreet, and I trust them, $185, 185,000 jobs. Okay. Go. Carlos says, so I suppose we could agree the euro dollar is going to 117, right? I don't know. We'll have to look at that. Okay. All right. So you get the concept of what we're going to do next. We're just going to look at ISM services, the employment subcomponent, and we're just going to look at the number and guess, is it going to be higher or lower? Now you can go along with me and do your own version, and your guesses might be different than my guesses, but that's okay. I'm trying to show you how to do the work. All right, so let's do manufacturing first. Okay, and we go down to employment. we're above 50 and rising. Albeit we're rising slower, the relative change is slower, but it is positive. Okay, so this is ISM manufacturing. So this says we're growing, so you got to go higher than $1.85. Great. Now let's take a look at services. Beep, 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 beep. By the way, if you like this whole process, this is probably way different than what you thought we would be doing this morning. If you appreciate us going through this and trying to figure out, and in fact, what we're doing is we're creating a model. If you enjoy this, make sure you click the like button and give FX Street some love on YouTube. Click the thumbs up button and say, hey, YouTube, this FX Street thing is epic. Okay, services contracting, and it's below 50. It was 51.5. Then it dropped to 49.8, which is technically contracting. Okay? So not good. Okay? It was growing, now it's falling. So we got to go back and say, well, services is bad, which means people at Facebook got laid off. Okay, so lower. Robbie, how do I find FX Bootcamp? If you can't figure that out, you're not ready. Google it. You can figure it out, Robbie. Come on, Bubba. Come on, Bubba. All right, weekly jobless claims. So for this, where do we go? You go to the Fed, and we'll type in weekly jobless claims. And I actually create the chart from the database. And let's adjust this. We don't need to go back to 1960. Let's look at the most recent trend. Okay. All right, let's even zoom in a little bit more. Okay. These are people losing their jobs. Okay? People losing jobs. So it seems to me the trend has been down, 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 down. We were at 241, then 231, okay? Then 223, and now we're way below 200,000. We're only at 183,000. This is people losing their jobs. So does that say NFP could be higher or lower than market expectations? Remember, it's very subjective. But does it show like NFP is going to be down, or does it show that NFP could be up? Type in a question mark if you don't know which. You're like, Wayne, I actually don't know. What does it mean? Talk to me, Goose. What does it mean, Basil? That's right, Hannah Panna Popana. All right, so weekly jobless claim said NFP could be higher than expected. Cool. All right, what's the next one? Jolts. Okay. All right, this has to do with jobs being advertised. Okay? Jobs being advertised. Okay? Now, These are the jobs available right now in the United States of America, at least the ones that are being advertised. Okay? Look at this, guys. 11 million jobs available. It used to be about 3.5. Then it went to 5. And then it went to 7,500. Then we got crushed with COVID. And we went from 5 million jobs available at the bottom of COVID to almost 12,000. So we're now only at 11 million jobs. And now look at this. Go a little closer now. How come it didn't do it? Oh. Go! Okay, check this out. Even just recently, huh? You see that? Just recently, up. What does this mean? Companies have more jobs being advertised, okay, than just a few months ago. They're recruiting. Now, it's not above the peak, but it's also no longer falling. The amount of jobs being advertised has gone up. The amount of employees being recruited has gone up. So I could argue here that maybe Jolts is higher. Cool. Oh, I forgot to do NFP, huh? All right. Now, NFP sometimes is tricky. So let's go back to Fred. Because remember, the non-farm payrolls is actually two different reports. So I don't... Yeah, see? That's the dead one. Private payroll, see? They break it down. This is actually a little tricky. I've forgotten how to do this one. Non-farm. See, that's the old. All employees, total non-farm. I don't know. We'll take a look at that. Why isn't it moving? Hello? There we go. Is that quite right? It's not quite right, is it? All employees, total non-farm. Gets us right back to this one. I guess we'll use that one. Or we could do unemployment rate. Let's do unemployment instead of employment. Let's do the opposite. Unemployment. Unemployment rate. Okay. Okay, let's do that. Let's zoom in. I'll change the, I'll change this from non-farm payrolls to unemploy. Okay, so that's the level of people looking for work that can't find work. And what do you think? Does this look bad or does this look good? In October, we were 3.7, then it dropped to 3.6, and then it dropped to 3.5. This is the percentage of workers that don't have a job and are looking for work and have not yet found it. Okay? That means there are lots of jobs available. In fact, 1.9 jobs for every worker. And according to this, people have no problems finding jobs. Okay? So this would probably, if we do it this way, this says higher. Because if we were in a problem, we'd have more and more and more people out of work. And right now I'm trying to do quantitative analysis to see if any of that is actually true. Okay? Great. Good. Let's do ADP. ADP, 106,000. Okay. That's interesting. Historical data. That's really what I want to see. Oh, good. They zipped it. Thank you. I gotta move. I gotta move. Give me the juice. Is it gonna open or what? There it is. All right. Is this gonna help? Well, we don't need to go back to 210. No, this isn't gonna give me what I want. Just give me what I want. Nobody gets hurt. All right, whatever. 106,000. I was trying to just see what it was before. And of course, they don't give me that. They give me a bunch of other information that I don't need. This looks like it's right off the Fred, huh? Wow, can you do that? So anyways, according to the department, so imagine they're human resources in a box. So small and medium-sized businesses, probably 10 to maybe 200 employees. They might hire ADP to do all that, to be their HR department. And so those companies, small and medium-sized businesses, added 106,000 jobs. And then you break it down into sector. What I want to see is the trend. And I don't have, it's going to give that to me. No, didn't think so. Got to make a guess. I think that's less than it was, but it's still positive. But you know what? I'm going to put that down as, because I know it used to be higher, right? Yeah, it was 230. Yeah, so let's do ADP, let's say lower. Okay. And now let's do Challenger, Christmas, and Gray. Challenger, Gray, and Christmas. And you got to find their research. Oh. Where did it go? Where is it? That's not right. 2 minutes. Where is it? Oh, again. Where's it? Contact for media? No, just give me the report, dude. Bonus report? No. 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 Challenger survey. See, that's not right. Where is it? Gee whiz. Dude, it's a nice website, but you can't find anything. Outplacement. Just go back to press. Does anybody have the link? Okay. All right. You missed a click on the heading that reads January 23 recession. Yeah, but it's, that shouldn't be it. That's a terrible headline. Yeah, anyways, okay, that is it. What a terrible headline. This should say, this is the report you're looking for. I mean, okay, anyways. US-based employers announced 103,000 job cuts in January. 136% increase from December, but December was way up. If you remember, I showed you December was way up. So there's a 136% increase there and 440% higher than a year ago. 440% increase in layoffs. All right, so that's subjective. Oh, hang on, I'm just trying to move this. All right, so Challenger Gray and Christmas is lower than 185,000, right? So let's now do a plus minus. Okay, so we'll go, well, that's not what I wanted. Plus minus. No, plus minus. Let go of it, dude. No, I don't want a formula. I just oh, I clicked equal somehow? Interesting. Okay. Plus minus. Is it going to let me do that? Still won't let me do it. It's trying to do a formula. Gee whiz, come on. I have to format the cell. All right, forget it. So I'm just going to do a plus or minus. So lower is a -1. Higher is a 1. Higher is a 1. Higher is a 1. Higher is a 1. Lower is a -1. Lower is a -1. Okay, so this is equal to the sum of, where's my mouse? Okay, and it's going to be higher. Okay, slightly higher than 185,000. So what do you think? 222. Now the other way that I used to do it is I would look at, okay, now this, okay, like that's just somehow saying it's going to be slightly higher. It could be way higher, it could be way lower. This says slightly higher. The other methodology that I used to use is I would do this. I would say, so Challenger and Christmas and Gray, right, was what? Negative, right? Well, in this case, we know it was 103,000 laid off. So the other thing I used to do, and this will give a quite different answer, I'd say this is equal to what the market expects minus whatever Challenger, Gray, and Christmas told us. Oh, what did I do there? All right, well, I guess I can do that. That's, what? Oh, jeez, come on, Wayne. Okay, and I do it like that. So it depends on your methodology, and that's the difference in the model, right? Okay. Okay. Sandeep says, does the platform make any difference in trading? Why would it make a difference? You either like it or you don't like it. You either find it easy or you find it complicated. No, it shouldn't matter. But it can. Okay? It can, because sometimes, sometimes when you have an institutional client, they're like, Wayne, we need you to trade on this platform because this is where we've onboarded, right? This is where our trading desk is. We're at this firm. Here's their platform. And you get there and you're like, oh my God, this is esoteric. But they're like, but that's where the money is. And so that's what you need to use. Okay. J-Man says, are you expecting a higher unemployment rate? Well, dude, that's what we're doing, aren't we? Okay. So you might say here, if you add up all the categories we just looked at, it says probably an okay non-farm payrolls. So if non-farm payrolls comes out 200,000, is unemployment going to fall? Is unemployment going to rise? Unemployment is probably not going to rise. Okay, this is a model, guys. Now you can change the variables, you can change the methodology and get different answers. So it's like, what do you think? Now, typically what I do, like I said, that I showed you two methods. What I was showing you before is typically I let all the analysts do their work. And all the analysts come out and they say $1.85. And then I say, you know what? You've missed Challenger, Gray, and Christmas. So it's going to be lower than expected. Okay. All right. All right. So whatever. There you go. So now you've looked at it. Why are market makers messing with your open position? Why? You have $1 billion position somewhere that a market maker is going to be attracted to? You're like, no, I got too many lots. Nobody cares. Nobody cares about your too many lots. So I would remove the thought. I'm not trying to say you're being silly, but you're being silly. So I would just remove the thought process. Okay? Don't think that way. The market makers are messing with your positions. Like, dude, forget about it. Don't think that way. It's not helpful is all I'm saying. Even if it was true, it's not helpful. All right. But I know that messaging has been pushed by somebody on YouTube because I've been hearing that more and more over the last year. Maybe a year, maybe a year and a half. So it's just somebody's popular, but like nobody cares about your position. Yeah, they're hunting your demo position, right? Like it's just don't even think that way. All right, so we got some time here, right? About 20 minutes. Let's take a look around the world and see what else we got. Let's take a look at the stock markets and see what's going on. What's going on? Nothing's right on board. Right? All right. Australia's up. Okay, riding the moving averages here, riding a 4-hour 5, doing really great. Got to get my drawing tool, my handy dandy notebook. Where is it? Oh, wow, it's way over there. That's crazy on the other side of my screen. All right, cool. Let's take a look. Bottom. Cool. Nice. Higher high. 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 What do you stink? Smell like a plan? Okay. Is it wise to short a stock on the open of the news being released? It's like the dumbest thing ever. It's degenerate gambling. Really? No. I think you should do analysis and develop strategic plans and then carry them out tactically. But like, sell a hot stock on a release of an NFP? No, dude, come on. Amateur hour. Amateur hour. Come on, man. Do the work. Cool. Anyways, a little 3A2 on the NASI. Okay, so that predicts a 1618. So what that's trying to tell us, okay, what that's trying to tell us is if things go well, remember NFP could flip this on like a light switch, but technically that's what the chart says. The chart isn't thinking about NFP coming up. Okay? But again, if you're doing technical analysis, it says up, down, right? Into the buy zone, and then up to there. Two things actually say that that's the next high. One of them is Fibonacci. The other one is pivot points. Okay, this is the buy zone here, and based on pivot points, the target is there. And that's about the same, don't you think? Anyway, so there's your NASI. You got the Euro 50 here, S&P 500, Oscar Mike, FTSE. Okay, these are on fivers though. Let's put them on hourly. And they look like they're taking off, but nonetheless, this could change in about 20 minutes. Yeah, we could look at Ethereum, sure. In fact, why don't we zip over there? So right now, the stock markets as a leading indicator say up, but remember, they're not thinking, well, I suppose you could argue if someone was buying the S&P 500 off that 21, one of the things they're thinking about is, a positive response to the NFP numbers. Otherwise, you wouldn't be deploying capital. Yeah, we could take a look at some crypto if you want. I won't look at them all, but we could look at some. Here's your ETH. And I have it trapped here. Okay. And one of the things that we're looking at over time here is that when things are in a range, I tend to say that they're going to stay in a range forever. So I'm thinking kind of like this. This is what I think. It's going to do this forever. But what is relevant to me is if then it does break. So it's going to stay sideways forever until it breaks. And then if and when it breaks, you become a bull. So like I'm close and not quite there. You could also argue that that's not the right number. This is the right number, right? You see? So, we got a little ways to go, but it's setting up. Okay? Okay. Okay, there's Ethereum. We'll zip over to Biddy. Okay. And one of the things if we see some risk off today, one of the things I'm thinking will happen is if there's risk off. So NFP comes out in 15 minutes and the market sees the number and says it's bad. Maybe that the Fed will have to raise interest rates higher, and then they got to price in an extra rate increase, and then or remove one of the cuts, and that's bad, and that leads to a stock market down, and that leads to Bitcoin down. Bitcoin I have coming down into this area here around 2100, and then plausibly a recovery here. Now, why do I say more up? Well, it's just technical analysis. So until the technicals change, that's what it is. Okay? Okay? Yes, Gabriel, it is typical analysis. So you have to, there's a couple of things going on here, Gabriel. He got blocked because of his foul language. But whatever, look, yes, I have lagging indicators here. I understand that, okay? I'm also looking at macroeconomic conditions, which I think are deteriorating, but we have a risk on flare. Sentiment right now is risk on. I think the risk on is actually wrong, but whatever. I don't fight the market and I don't fight the Fed. So anyway, so here we are. So I got to deal with that, okay, Gabriel? So what the chart is saying, Gabriel, is that the market is bullish, and on the longer term, because it's a trend, if you believe in the word trend means it'll continue. Okay? No, I do the same, Gabriel, but I'm showing amateur traders on a free live stream how to do basic things like analyze the market. So I'm showing basic levels of technical analysis. But I know it's basic. But dude, okay? So anyways, what this is showing is this market is bullish. That's it. And so you try to project here a continued bullishness, because continuation means trend. So let's just put this to represent kind of the future of that. Let's do this to kind of represent the future of that. And so what you're trying to do now, everybody, is use smaller time frames to anticipate that they're probably, remember, we're talking about probabilities, some sort of pullback and then some sort of future rise. And this is an assumption that market conditions will stay the same. Okay. Okay, that's all that says. Now, if you're going to do macroeconomics might say, well, over the next several months, there's still a reasonable chance that macroeconomic conditions deteriorate. Okay? If that's your flavor, then what you're doing now is you're saying to yourself, okay, somewhere in this region, because that line is actually an important line. Somewhere in that region, somewhere soon, meaning in the next several days, maybe even the next several weeks, that the world's going to wake up to a much different hypothesis. So like NFP could lead to, a negative outlook. Okay. And what'll happen then is you'll see this drop, and then you'll see a double top, and then you'll see a lower low, then you'll see a lower high, then you'll see a lower low. And now you have that confirmation that the market has changed. And a bear is best off waiting to sell a double top on this line, which we already know is an important selling line. Then you get the lower low, lower high scenario. So now you have the price action. So, you either sell here as plan A or you sell here as plan B, and the rest is just waiting. Cool. Good. That's called patience and discipline. Where can you get the MT4 indicators? FXBootcamp.com. It's $88 a year to have a membership. You get 88 hours of hardcore foreign exchange training videos and my indicators. Okay. Other things we can look at quickly. Let me show you this. Let's bring up this page. All right, here's some more quantitative analysis of the market. So for those that are more interested in institutional positioning, I do look at institutional investing, right? So you can see where money is positioned. Okay, you can see changes in the positioning and then rankings of them. Okay, I like to organize my thoughts, okay, by the quantitative analysis of all these pairs. Okay, I even look at retail versus institutional positioning. But like we could zip over to euro dollar. And I like to look at GDP growth between Euro and America, inflation between Eurozone and America, unemployment between Europe and America, interest rates between Europe and America. I like to look at seasonality, not just of the dollar, not just of the euro, but comparing seasonality of the euro and the dollar to get 5-year and 30-year trends. I like to look at the technical analysis. Okay? And find out mediocrity. Okay? So you're like, huh. So maybe I can zip over here and say, all right, well, is there something better to be looking at? And we might want to look at somewhere in the future. I might want to cross pair here and zip out to like Aussie CAD is not good now, but it might form in the future something very interesting. You can see coming up next month, there's a cliff coming. So Aussie CAD is slightly up right now. Technically, you can see the trend reading is up. And Canada's paused and Aussie is raising. So this might be different than the normal 20-year trend. Anyways, there's a lot of other interesting things going on. You could look at things like rates of gold and oil and treasuries. Oil's very bearish. Okay, very bearish over here. Retail's long oil. The retail traders keep buying oil. Whoa, whoa. Oh, so what I wanted, if you guys want today's report, well, let me ask you, do you want today's report? Here it is. I ran a report today, this morning, in fact, right before today's webinar. And it'll give you the dashboard, the scorecard summary. It'll give you the smart money tracker from this morning. It'll give you all the dollar pairs. It'll give you the yen pairs. It'll give you the S&P 500. It'll give you gold and oil. All run this morning. So there you go. You can download that today's report for free. It's a big PDF. And of course, it'll make you an offer if you want to subscribe. But it's there it is. All right, we're about 2 minutes away. Are you excited? So once again, my name is Wayne McDonell. I run a community called FX Bootcamp. I've been doing that for about 20 years. It's $88 a year. Try fxbootcamp.com. I roll with tradersway.com, an ethical, trustworthy foreign exchange broker. They earned my loyalty and respect when the Swiss National Bank went out of business, practically. They freaked everybody out. They lied to the entire market. Markets were roiled. And some major foreign exchange brokers went out of business. Possibly because they were trading against their clients and then got caught holding the bag when there was a black swan event. Trader's Way was perfectly fine. And what that told me, my interpretation of that, was they actually execute your trades into the interbanking system and they don't trade against you. And they instantly earned my loyalty and respect. Yes, they have fast execution speeds, narrow spreads, huge swaps, but they earned my loyalty and respect through their behavior and actions in the real world. Check them out, man. Tradersway.com. Okay. Okay, let me, I want some news here. If you get the headline, let me know. Wayne at FXBootcamp.com. I've had the same email address for 20-something years. I've had the same phone number for 30 years. Wayne at FXBootcamp.com. I'm like the most visible person in the world, Gabriel. You can find me. Come on, man. All right, so we're imminent. Let's not watch Bitcoin. Let's watch the indices. Let's watch Dixie. Oh. Dan, my man, is like, oh my God. Oh my God. Yeah. What do you think? So we went through and we thought, It'll be higher than expected. Well, Robbie, you can disappear if you want to. Look, I made the cheap. I don't know why you would say $88. I mean, I used to charge thousands. I could raise the price if that makes me more credible. I've been doing this for 20-something years every single day, Robbie. But you don't have to love me, man. All right, let's zip around here. Actually, let me zip back to the indices. I don't care, Robbie. So anyways, Aussie getting taken down hard on this. I would expect Euro as well. Let me zip over and place this here. More on the hourly. Yeah, Dan is like, it's really crazy. Yeah, it's amazing how they could be so wrong. The thing is, there's a lot of revisions, right? So I want to check into that as well. You're a lawyer? Oh, congratulations. Yeah. So household survey, 3.4. Okay, January labor. Little change. Unemployed, part-time, little changed. Labor force participation rate, little changed. Among those not in the labor force who wanted a job, little changed. Establishment survey, this is where the survey of businesses. Yeah, okay, compared to average gain. Okay, job growth widespread, led in gains in leisure and hospitality. That's interesting. I didn't think that would be that great. Professional and business services, all right, and healthcare. So hotels and restaurants basically added 128,000. This is interesting. Government employees. Ah, shoot. Government employees. The government added 74,000 jobs. Wow. Healthcare added 58,000 jobs. Wow. Retail rose. Really? That's really interesting. Construction added 25,000 jobs. All right. Transportation and warehousing added 23,000. Wow. Social assistance, 21. Wow. Manufacturing continued its uptrend. So we looked at that. 19,000. Little change in mining, oil and gas. So that's holding steady despite oil prices down. Wow. Okay, here's where we get to the next thing. Okay, so what we want to look at here is average hourly earnings, because this is inflation related, rose over the past 12 months. We have 4.4%. Well, this used to be over 5%, but you know, it's 4.4% higher than it was, and it was higher. So it's still going up, the rate of change is down, but still, this is what the Fed looks at, by the way. They don't really look at the jobs. They're looking at wage growth. And then right? So in January, average hourly earnings of private sectors rose by 0.2%. All right. So anyways, we have wage inflation. The average work week, which is, again, something they look at, rose. Workers are being more productive. In manufacturing, look at that. That's interesting. Manufacturing, wow, over 40. With overtime. Average work week for production non-supervisor increased by, wow. Okay. The change in total NFP for November was revised up by 34,000. Okay. So it went from 256 to 290. So NFP went up for November. December NFP went up by 37,000. With these revisions, employment gains in November and December combined for 71,000 more jobs than reported. Oh, God. Huh? Yeah. Interesting. That's crazy. Where's my mouse? I lost my mouse. Wow, that's craziness. So red hot market. Wow. Anyways, that's really a red hot. Wow. Okay, nobody expected that. Huh? Nobody expected that. So now I want to do another level of analysis. Okay, let's do another level. In 47 days, we have a Fed decision. So how's the market repositioning itself? Okay. So this went up a tick or two. This used to be 80, 83, 84. Now it's almost 86. That is changing. So more people now believe the next meeting will be a hike. That's not that big of a shock. But I think some of these other ones are really going to change. So remember, now we're looking at May. We're currently at like 4.5. And then March. Okay, let's go back to this. March gets us to 475. And in May, 475. Half the market thinks there's only one more rate hike. Okay. Okay, so that's interesting. That's interesting. Now, I have some data from yesterday. Well, actually, it'll have it down here, right? So yesterday, where were we? 475. Yesterday was 58 and 30. Okay. So since yesterday, which means just really because of non-farm payrolls, I want you to think about this. This is, by the way, if you don't know what this is bankers, okay? Bankers negotiating with other bankers. Oops. And they're negotiating hundreds of millions of dollars, tens of billions of dollars. Like, it's a big deal. And they're negotiating contracts of money over time. And since non-farm payrolls came out, like since yesterday, okay? So just imagine, because of this red hot number, this went from 30 to 45. What does this mean? The market is now pricing in. So when you hear this in the media, what is priced in? Oh, this is priced in. That's not priced in. If you've ever wondered what that is, this is what we're talking about. And what's happened was yesterday, okay, let's delete this now. Yesterday, one hike by the Fed was priced in. Now we're closer to 2 hikes. So this has to now be priced in. Okay? And as I teach, when the flow of capital is this way, in this case, interest rates rising, or the probability of interest rates rising. Remember, this isn't a survey. This is money being negotiated and contracts signed. Not an opinion, not a survey, but actual billions of dollars on the line. That's why I like this. Okay? So anyways, so what that shows is US dollar strength. Now you can go further out and we can go even farther. So let's say now what the market is there's almost a 50-50 chance that by May we're at 500, right? 5 to 5.25%. June. Okay? Pause. Okay? July. Pause. September. Cut. There's still a bit of a cut in there. November. There's a cut somewhere in there. We're not talking about 5.25. We're talking about most of the market position between 4.5 and 4.75 in November. Okay? Again, going out to December, we were at 5 to 5.25. The market is positioned now, even still, 2 rate cuts. Okay? So one of the things you need to watch over the next few weeks and months, in particular after this crazy NFP, a lot of that's going to shift. So we're already seeing, let's say 50% more likely than yesterday. We went from 30 to 45, so 50% of 30 is 15. So you add 15 to 30 and you get 45. So, an increase in the probability that the Fed rate does 2 more hikes and then pauses. But what I think is more important is the end of that curve. I think whether we actually go to 5 or 5.25, really for the economy is irrelevant. For short-term positioning, it matters because, you know, people would be too weak, too bearish on the US dollar. But those rate cuts at the end of the year, that's where I really think the market is probably wrong. And that means the dollar is too weak. Okay. Okay, and you can see, let's not go that far out. This is a major change in direction. This was an important number, this non-farm payrolls. Okay, so let's take a look and see how the stock market's behaving with this. Okay. Okay. There is both this, and I want to kind of focus on, I mean, obviously I care about the S&P 500. So I don't really care about the hourly. So what I talked about yesterday, okay, was this idea that we need to breach through the 21. We're going to run into that role reversal. Okay. But we'll breach the 21 for the first time in a long time. And then next week, kind of, if it does this, then we have that possible kind of move back to retest 4,000 and plausibly below. In that case, based on what I see here, based on technical analysis, okay, that we have a 39, 38, 88 kind of thing as a potential bottom for the month. Okay. All right. So down, pay attention. There's definitely support in here. And then maybe that lower high. Remember, technical analysis won't predict if it's going to make a lower low. So you have to assume down into support and then a directional change there. There's only two things a bear can do. So let's go back to the very basics. A bear can only sell a double top. That's not a double top. Okay, that's one thing. You can sell bears. Okay, bears sell. I think we can agree with that. Double tops. Right? So a double top is that. Or lower highs. So the other way of looking at that is it drops down to here, and the lower high is somewhere in, you want to pick a number. Is it this moving average? Is it the pivot point? Yeah, we could do that. So lower high. Ends up being about the same. It doesn't really matter. But here's the thing. We had a dramatic change in sentiment because of the news, which makes sense. Now, as a bear, you don't want to sell low. So a lot of you are like, oh my God, it's moving. How can we sell it? Whoa, 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 dude. I'm here all day, every day. I'm not missing a dang thing. It always comes back for me. I'm avoiding the volatility. So here's my plan if I am now a bear. Now, technically, I cannot be a bear yet. That's the other thing. So what might happen is down to 41, up to 41.60 or 41.50. And that would be my first opportunity to sell if I wanted to be a bear. More conservatively, you would then get the lower low and set up the new lower high, and I probably get the number here. See, now I'm using technical analysis. And I'm not using it to make more money. I'm using technical analysis to lower my risk. Okay? 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 So, again, your two choices are you can sell the double top up here because, look, let me put it this way. Bears don't sell here. Okay? Bulls take profit there. Okay? That's not bears selling, that's bulls exiting. So, because a bear can't sell a higher high. Bears don't sell higher high. You see? So a bear could sell a double top. This is just basic technical analysis, or a lower high. Because look, I'm a macroeconomic trend trader. So yes, I need the reason for this to fall. And I have plenty of reasons. Okay? About 3 weeks ago, I outlined the entire year in advance. So I do have some opinions based on analysis. So if I thought this, I can't sell a higher high. That's the concept that I'm teaching. So we had an amazing NFP, and the Fed might have to raise interest rates further. And that would bring down the economy. Okay, great. But I can't sell the higher high yet. So down, 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 up, up, sell. Down, 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 up, up, sell. Down, 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 down. So I start with the macro. And then I confirm or deny my fundamental macro bias. A bias is an opinion. A bias is a strategy. I confirm or deny that with technical analysis. So like I look at this chart, I thought about selling here. And then technical analysis did not confirm my macro bias. Okay? Got close. I waited. Oh, didn't get it. Okay? And then I waited. Nope, didn't get it. Waited. No, didn't get it. Okay? So now I could just jump in and say, finally, NFP confirms my fundamental macro bias. No, but it's not confirmed in technical analysis. So I can't sell here. But look, if we drop down lower like this, this would confirm technically, of course I want to be here, not here, but technically it would confirm my macro bias. So now my macro is confirmed by technicals. And now I have, now I have permission to engage. If, remember, it's an if-then study. If I get a double top, double top, or lower high, then engage in selling. And now I could get off a 4 hour, I can drop into a 5 minute, sell the rips. You know what I mean? You see? So those are my rules of engagement. Now, you might disagree with it. That's fine. To each his own. One of the things I have learned over time is that I don't really believe the market is a zero-sum game anymore. I've matured. I found that instead the market is a symbiotic dance. Bulls have their turn, bears have their turn. Bulls have their turn, bears have their turn. And on small time frames, but even larger time frames. Okay? It's a symbiotic dance. Left foot forward, right foot back. If you're a bear, but you can be patient in a bullish market condition. So that if it's left foot forward, okay, you don't get your toes stepped on. And you don't step on their toes. And instead, you're just waiting. You're listening to the music. You're enjoying that evening, as far as you want to take this analogy. But the thing is, you don't need to fight the market. There will be a time when this turns bearish if you're a bear. But the one thing for sure is bears don't sell higher highs. And so I look at the market like this. Let me delete this out. Okay, I look at these old highs and I look at this new high. I don't sell that. Well, Wayne, we just had a crazy non-farm payrolls. I don't really care. I don't sell higher highs. So the market can be inconsistent. Good news one month, bad news the other month. Then we have like seasonal pressures. We have sentiment changes. We have the market positioned wrong, but the market's going up and all this kind of stuff. Like, it doesn't matter. Because you're always going to have all these variables and black swans and did you hear what this politician said in that country and all this stuff. Like, all this matters, right? So what it comes down to is you need to be consistent in a market that is usually inconsistent. You cannot be inconsistent in your behavior in a market that is inconsistent because of the million variables that matter. So the only way, or let's say the best way, the way to optimize your returns, okay, is that you're consistent even though the market is inconsistent. And what I mean by that is you never sell higher highs ever. So if you're a bull, you could buy a dip. Okay? If you are a bull, are you a bull? I don't know. And I wouldn't argue if you were or weren't. I would ask you, so why are you a bull? And you would give me a PowerPoint presentation, maybe 1 or 2 slides with all these bullet points and a little bit of research. And you're like, I'm the bull because of these factors. I'm like, oh, cool, right on. And then I might ask a few questions, but I don't know the future. So if you're a bull and you've done some research, this is what I would do if I were you. Something to that effect. And if I was a bear, well, the one thing I know, I can't sell there. That's why I know there's no bear selling there. But a bear could, like I said, sell a double top. And if so, their target is here. Why is that the target? That's just technical analysis. It's not my opinion. Now, Spencer says that interpreting the data is subjective. Yes and no. So like, let me bring up this. Okay. So when looking at gold, you can look at all these different rationales and you can determine whether you should be a bull or a bear. Now, quantitatively, it's neutral. Is that subjective? No. The Dow, for example, or Euro Yen. Let's do Euro Yen. Is that subjective? No, it's not. It's quantitative. You look at the fundamentals, GDP, inflation, employment, interest rates, bias towards interest rate differentials, institutional positioning, retail positioning, 20 and 5-year trends and seasonality. Okay, again, the technical analysis is incorporated in there, and you put it all together and you get a score, and this says sell. Now, does it mean sell this second? No, it just means quantitatively this makes sense for down. it's more bear. It favors the yen more than it favors the euro. Now, this still might be up. Now, that's the next part. And I think that's what you're talking about, Richard. So you're like, well, why would this be trending up? You can see the trend is bullish. Okay, now that is where we get to subjectiveness. That's like market sentiment. Sometimes people do what they always do, even though it might not make sense in today's world. Or quantitatively, you would have to adjust your scoring mechanism to say, well, there's yield curve control adjustment at the Bank of Japan. Wait. Well, how do you incorporate that into the model? Well, it's difficult because if you start incorporating every variable you can think of for every central bank in the world, you're going to have this mixed bag model. And what you're going to do is start tweaking your model to fit your own opinion. So you want to keep it as quantitative. So you're like, okay, just comparing the normal, let's say, factors of productivity, okay, capital and labor, okay. When you do that, you say, okay, looking at these things and what usually happens based on normal flows of capital around the world, you get this number. It's good or bad, okay? Just this. It's just quantitative. It's up or down, okay? But then we know there's more to the world than that, but most people don't even know that stuff. But then we say, okay, well, what's the world trying to work on? What's the future? And an algo can't think of a future. So we know, like, the ECB has already told us their next meeting, they plan on raising by 50 basis points. Oh my God, they told us. The algo doesn't know that. So we might throw that in and say, well, that gives a plus to favor euro. So now that's market sentiment. So now the market might favor. Cool. Okay. So now if you had a bias based on some sort of analysis, you could go to like a yen. Okay, and then set up your bias, set up your trade. So if you are a bear, how do you do this? If you are a bear, you look at resistance. Why do we care about resistance? Because we're looking for lower highs. So you either sell a top, like a double top, triple top, quad top, pentatop, okay, tops. You either sell tops or lower highs. So you have plan A and plan B if you're a bear. So that's where you got to get first. Are you a bull or a bear? Are you a buyer or a seller of this asset class? Well, plan A would be something like that, either today or next week. Remember, next week is totally fine. Okay? And then this way. Now, Carlos says, Wayne, I believe your formulation opinion rooted in quantitative data is subjective because to justify market direction based on such data has not always been the case. Well, look, yes. Your interpretation of how the market will behave would be the subjective. And that's where you got to think about the sentiment. And then the other non-quantitative, more subjective stuff, like maybe what Christine Lagarde has told us, or what the Bank of Japan has put on a press release, you can consider that subjective or quantitative. And the thing is, I don't want you to tinker with your model too much, because what happens is you end up backfitting everything. So you got to be careful. So you got to start with a basic theory, and it doesn't have to be overly complicated. Okay, Carlos? And like, for example, 20 years of seasonality analysis is well, it's factual. That's the number. If you look at what Euro Yen does every February for 20 years, and then, kind of average the whole thing out, well, it usually goes up. Cool. Well, that's factual. Doesn't mean it has to go up this year, but you want to think about, well, in a normal period of time, there's a normal ebb and flow of capital. So we're foreign exchange traders, and our job is to understand the flow of capital around the world. Why is it flowing there, and when does it flow there? The Australian dollar will get stronger when China increases their purchases of iron ore and coal from China, or from Australia. That is a fact. That is going to happen. The question is, what do you need to watch to see it happen? So, like one of the things we've looked at recently, and I say we, and I mean FX Bootcamp, let me pull this up. Okay, so we did this at FX Bootcamp, several days ago. Okay, we'll let this load. Why is it not loading? Come on, Bubba. Why is this not loading? Well, let's try it again. Reload. They're loading their ads, but not the chart, huh? All right, well, I guess Bloomberg lost us. Let's go back. Let's just do this one. Will this let me go back in time? Okay, well, that's good enough. Okay, look. This is the Baltic Dry Index. This is trying to track the price of shipping things like iron ore and coal around the world. How many people here agree that if China is buying iron ore and coal from Australia, that they're selling Chinese currency to buy Australian currency and then give the Australian currency to those that are producing iron ore and coal? How many people get that point? That it's not just China being short of these materials. That's not what we're trading. We're trading that to pay for iron ore and coal, China needs some Australian currency. An iron ore miner in Australia just doesn't accept Chinese yuan. They need to pay their employees and maintain their capital in Australian dollars. So that's kind of the thought process here. So when will China increase its purchases of iron ore and coal? Well, we don't know. They might have built a surplus of iron ore and coal over the pandemic. Remember, they were closed for another year, right? So they may not have consumed as much. Now, what is coal used for? Well, coal is the number one fuel in China for producing electricity. So if people leave their apartments and go to restaurants and then go to work and go to the factories, well, it needs more power than it did last year. The factories need more power than last year, so on and so forth. Now, China has a lot of coal, so they might have produced some. I don't know if they shut down their coal mines or not, but they probably have some surplus because they just weren't using it as much as normal. But the other problem with China, and I've met with Chinese government leaders. I really have. And they want clean energy. Not just do they need energy, but they prefer clean energy. Now, it's not always available, but that's what they prefer. The coal in China is much cleaner. The coal in Australia is much cleaner burning than the coal in China. China has dirty coal. Australia has clean coal. So they prefer to buy Australian coal. But also, they can't produce their own dirty coal as fast as they're burning it to create electricity. So there's two things going on here. Soon as there's an increase in demand for electricity in China, they will consume more coal. And eventually they will burn through any inventory that they have. And no matter whether they like it or not, they're going to buy more coal from foreigners. That means foreign exchange. This is where we get in. And if they had to make a decision of where to get the coal, Australia has clean coal. It's cheap to manufacture because the mountains are gone. It's easy to get. And it's pretty close to China. So what do they do? Oh, and by the way, why do you need iron ore? Well, when you melt iron ore into liquid iron, molten iron, and you sprinkle in some coal, which is carbon, you get steel. So if you're going to build skyscrapers, right, you're going to need some steel. If you're going to make electric vehicles, you're going to need some steel. And that's just iron ore mixed with a little bit of carbon. So think about iron ore as being steel, the major input. Now, the two major exports for Australia. The number one Australian export is coal. The number two is iron ore. This is the biggest part of the Australian economy. Remember, they produce this in exchange for money. Okay? Now, so a deal is struck between China and Australia. Hey, Australia, we want to buy a whole bunch of coal. Great. So the first thing that happens is they buy Aussie dollar. And if you're buying Aussie dollar, you're making money. The second thing is, well, they have to deliver the coal on a ship. When there's high demand for the ships, it costs more to rent the ships. And if there's a massive shortage of ships because everyone is trying to get iron ore and everyone's trying to get coal and everyone's trying to get soybeans, it's like a hopper car on the water. Then there's just a shortage of boats, so the prices go up. This is an index of those ships. So look at this. Do you see quantitative evidence of a massive increase of purchases of iron ore and coal from China, or by China from Australia? Now, Richard says, oh, so iron ore and coal prices are correlated with the Aussie dollar? Yes. Neat, right? So we don't see it. I don't see it. Do you see it? Okay. If we go back to May of last year, there was, right? Let's just call it, this is the price. Let's just say it costs $3,344 to get a boat. Now it costs $640. Now, why has prices dropped 80%? Because shipping companies feel bad and they're like, oh, well, we don't want to overcharge you. No. There's just no demand. Once this starts crawling up, you will probably, now again, it's probability, but based on the logic, you will probably see an increase in the Aussie dollar. It's not the only factor, but you have to think about following the money. If this goes up, there's demand for ships that move iron ore and coal from Australia to China. So those contracts, those deals, because remember, they're hiring the ship. Why are they hiring the ship? They've already signed a contract to buy Australian coal. So they sign a contract. In 3 months, deliver this amount of coal to this port. It's a futures contract. And how are they going to pay for it? Aussie dollar. So you need to acquire the ship, but you also need to acquire the Aussie dollar. Okay? Okay, what are the chances oil goes to 50? Okay, why don't we look at that? Nope, wrong one. Hang on. Where's the weekly coal production? No. Short-term outlook, probably this one. Nope, not that one. Nope. I don't think it's here. Nope. Hang on, I got to get inventories for us. Hang on. Not monthly. Just came out on Wednesday. Where do they? I always struggle with finding this stuff. I read it from my email. Annual? No. International? No. I guess maybe I'll do this one. Doesn't look right either. Hang on. Projections? It's not going to be there, is it? I want reports. No. Reports. All no. It was just one of the recent reports. I just read this. Gee whiz. I always struggle to find this information from the website. Again, I get this information just emailed to me, so I just read it on my phone. It should be the weekly update. Weekly. Coal, gasoline, propane, nat gas. This week in petroleum. I would guess it's this one. But I think I just looked at it, and yeah, this should be it. There it is. Okay, good. All right. Okay, so about 3 weeks ago at FX Bootcamp, oil was going up, and I guess how do I zoom in here? I guess I'll do it this way. Well, you know, I'll do it this way. Open a new tab, and then we'll zoom in. All right. So about 3 weeks ago, and again, the question is, Wayne, will oil go to 50? Well, again, you don't want my opinion. Okay, we're looking at the 5-year range. So this time of year, oil is somewhere between here and here. Okay, so about 3 weeks ago, I pointed out, uh-oh, because a lot of people were bulls. And I'm a long-term bull, but I'm like, dude, right now, the United States produces 12.2 million barrels per day. Oh my God. Okay, that's a lot. Do you know how much that is relative to normal? That's the all-time high. The United States has never produced 12.2 million barrels a day, but they are now. And for a long time, okay, oil was lower, critically lower than normal levels. Critically low. We were critically low. Okay? And much of this, much of this where we're back into the normal levels is the SPR. So even to get it there, we were doing extraordinary emergency measures to lower prices. Because if you're below the normal levels, okay, prices go up. So here's the thing. I pointed this out 3 weeks ago. Again, using facts. We have enough oil, bro. And we're producing it at record pace. So don't be so sure in the short run that this is going to go up, because that kind of says down to me. And we're now approaching, actually even more than average. See, a week ago we were below average, but I would suggest the average is somewhere in here, right? It looks like we're now above average. We have a lot of energy. And keep in mind, I think China's got a whole bunch of ships of Russian oil floating out at sea. And if India was buying energy from us, they're not now. They're buying it from Russia right now for cheap. So nonetheless, demand seems to be falling. Supply seems to be rising. Okay? And la-di-da-di-da. So 50, maybe. Now you would have to use technical analysis to confirm or deny. But again, what you want to be looking at is you start with a bias and then, okay, so you might look at that data. Okay, who asked the question now? J-Man. You look at the data and your question is there a chance of oil falling to 50? You can look at it and say, yeah, well, the bias is going to be bearish. So now you use technical analysis to confirm or deny the bearishness. You sell lower highs. And if it makes higher highs, you don't sell. What? And so if you go out to the 4 hour, we were at 82 when I was explaining this information. And it took a while, but I showed inventories are rising, inventories are rising, inventories are rising, inventories are rising. And it dropped, okay? It dropped from 82 to 75. You know what I mean? So look, my opinion, I think it's easy to learn technical analysis. Now, there are many different ways of doing technical analysis, and they're probably all correct. Oh, Wayne, I use Elliott Wave. Oh, great. I don't, but I think you'll do fine with Elliott Wave. I use price action and pivot points. That's what I like. And you might like something different, not Elliott Wave, not price action pivot points. You might like something else. To me, it doesn't even matter, because they're all different techniques to do the same thing. What are the universal truths of trading? Buy low, sell high. Keep your losses small, let your winners run. That's it. I don't care what technique or tools you use. Don't matter to me none. But the thing is, we should all be selling lower highs. We should all be buying higher lows. What you use to measure that? Well, that's up to you, dog. But no bears sell higher highs. Okay? Because it just doesn't make any sense. And you probably knew those rules before you even learned how to trade. You're like, well, I don't really know much, but I know you're supposed to buy low and sell high. Sweet. Okay? But which ones? You buy higher lows and you sell lower highs. There's a big difference. Cool. So we got the stock markets opening soon, so we got to zip back over there. Richard's talking about, he says, what about tracking futures contracts for future demand? And yeah, so what you're talking about is a time series. So you're talking about a futures contract. What is oil priced for March? What's the futures contract price for oil in April? What's the futures contract price? And that has to do with contango and backwardation. And do they tell you? Does it help? Yes, it does. But I'm not going to talk about it in detail here, but just think about it this way. If oil is cheaper in the future, you can read it in two different ways. One, everybody's demanding oil right now on the spot, so prices are going to be high. Or, to look at it the same thing from a different point of view, if you can just wait a few months, you'll get a better deal. So it's either you have a premium now because everyone's demanding oil now, or they're like, why don't you just wait and you'll get a discount in the future? So you're either look at it as you're paying a premium or you're going to get a discount. It's the same thing. But what does it tell you? There's not enough oil now, but down the road there is. And so you can read that backwardation. Now, why is oil cheaper in the future? It should be more expensive. And the reason for it is, if let's say you want to buy oil from me, and you say, Wayne, I need to buy 1 million barrels of oil. And I'm like, cool. I need, I need $78 million. Okay. And you're like, yeah. However, I don't need it now. Don't deliver it to my factory now. I need the oil in 3 months. Oh, I'm like, okay, let's work out a deal. And we negotiate based on what we think the future oil price will be. But actually what's happening is we lock in today's price, basically, right? So I'm like, okay, it's $78 a barrel. And okay, we agree on that. However, I have to store this for 3 months. I have to put this oil somewhere. And I get charged rent. It's not me just being like, oh, well, you're going to have to pay. No, I literally have to put it somewhere. And there's a fee for that. It might not even be my storage. It could be someone else's storage. So I go to the storage people. I'm like, I need to put 1 million barrels in oil for 3 months. And they're like, well, it's $100,000 a month on $78 million in oil. I'm like, oh, okay. So I'm gonna acquire a $300,000 expense. So I go back to you and I'm like, okay, I can do that deal, but it's $78,300,000. And he's like, whoa, you're charging me more than 78. I'm like, yeah, well, that's the carrying charge, the rental for the storage. You need to pay for that. So it's $78,300,000. And what you'll see is further out, prices should go up because of just simple things. You're paying for 3 months of storage, 6 months of storage, a year of storage. So, right? You see how, and so usually prices in the future are a little bit higher than they are today. What we found earlier in the year is oil got cheaper and cheaper and cheaper in the future. And you're supposed to look at that and say, wait, what? That doesn't make any sense. So what does it mean? Well, I would argue the future price, let's say 3 or 6 months in the future, is the right price plus the carrying charge. So that's the correct price. But then if oil now is higher than that, then there's way too much demand for oil on the spot market, or there's just not enough supply right now in the spot market. But there's something definitely wrong with the physical market. Supply or demand of the physical commodity. So again, I don't want to go any deeper than that, but to who asked the question? Somebody asked the question. Richard, I guess. I hope that kind of tickles your fancy and addresses that concern. So does it matter? Oh, it matters. Usually not that much, but it matters when it matters. I think the biggest thing in the U.S. energy market and really in geopolitics is the United States, and potentially illegally, in my opinion, tapped their strategic petroleum reserve and dumped it on the market. And they dropped oil prices from 120 down to 75. And I think they ruined their relationship with OPEC. I don't think we'd be at 75 right now. And also, unless we did that. Also, imagine inflation levels in the United States if we didn't dump 200 million barrels on the market. We'd be, the headline CPI number would be much higher. And that's part of my analysis now. I'm like, we're claiming victory that inflation has gone from 10 to 6.5. And we're doing a little victory dance, right? But I say, whoa, whoa, whoa. The only way we got that down to 6.5 was by manipulating the market for oil and gasoline. Oil and gasoline have a heavy impact on the CPI because if you're buying more stuff from Amazon, that hits you. Hello? You there? Oh, it looks like I lost you for a bit. Now YouTube, I might have lost a whole bunch of comments too, or questions. Well, let me see where you are. Oh, yeah, now. Yeah, okay, cool. I'm back. Sweet. I missed you. All right. So, yeah. So hopefully you got the cusp of what I was saying earlier. Thank you for your patience. Okay, going back to NASDAQ, we have this set up. If there are bulls left, this is their last hurrah on the hourly chart anyways. And if there are bears, they're really going to pay attention to the lower high, lower low scenario, right? So I tend to be sort of cynical, if you will. And I think you'll probably do the higher high here, but the lower high there, which is a time frame issue, 4 hour versus 1 hour. So, remember, you got let's do it this way. There's a couple of things you could look for if you're a bear now. Okay, double top, double top. And then some sort of lower high scenario. So that's where maybe Fibonacci comes in, maybe pivot points come in or something like that. Okay, so let's kind of do it this way. Do you want to do maybe next week's pivots? We can do it that way. So let me do this. I'll do it over here so you can see it. Template. We are going to do swing trading bearish, let's say. Okay, and go to the 4 hour, daily. Let's go to the 4 hour. And what this is saying is between these two prices. If you're a bear, you can consider selling. Now, I think this is premature, and I've already explained this, right? I don't like selling into this 21 EMA, but what this chart says is you probably want to get up to 12,750, and maybe it'll come down, and then you probably want to do that one. And so you'd probably count this as the double top, and then it would drop hard on Monday or Tuesday, rally up on Wednesday, and maybe you got yourself short Thursday. Okay? But that is still very technically bullish, and you should know that. Okay? That's your NASI. I identified this earlier today. We zip down in here and look what's happened. Down into support, which I already identified. You see, there's the pattern. There's a roll reversal in here. I did a technical thing in here. No. We have a moving average here. Okay. Remember, the moving averages are lagging, which means you're like, but Wayne, it never touched the 21 EMA. Okay, well, the analogy is this. You're a hunter in the forest, and to your right, you see a deer, so you stop. And the deer stops and turns, and now you're eyeball to eyeball. And then everyone's frozen. And then go! And boom, the deer takes off, and he's running from your right to your left as fast as he can. Well, the deer is quite a ways away. Do you shoot at the deer? No. You'll miss. So you have to shoot in front of the running deer. You have to shoot to the left of the running deer so that the deer runs into the bullet. Same thing. You're not going to see it touch this EMA until you're way up here, and this EMA will have risen, would have moved to the right, but also up because it's an uptrend. You understand that? Russell says most indicators are lagging. That's correct. That's why I don't use very many of them. Lagging indicators. Okay. So I use like leading indicators, right, Russell? So what this says is if you're a bear, my leading indicators say you probably want to look for something like that next week. So that's next week's bearish trade plan. Okay. This week's bullish trade plan is buy it here. So the real news for next week is what's going to happen up here. Well, this is where bulls and bears are going to run into each other. And bears, astute bears, are actually going to wait a little bit, and they're going to sell here if the bulls wimp out. As soon as they see weakness, sell. Now, what does this chart say? This chart says the 21 will hold and the S&P 500 will make a higher high. It's just technical analysis. It's not an opinion. What does the chart say? The chart says this. Okay, I'll take it further. The chart actually says a little bit more than that. Okay, here's what the chart says. Again, not my opinion. What does it say? Up, down, buy. Up, down, buy. Up, down, buy. Up, take profit. Next week's high, according to this chart, not opinion, not fundamentals, there's no algo, it's just technical analysis. So if this uptrend continues, this chart says the projected high for the month will be achieved next week, and that'll be just about 4,300 on the S&P 500. And if you're a bull and you're enjoying the upward trend, based on probabilities, you should probably take profit. Now, if you're a bear, that gets interesting for you because remember, that will create red candles. And you're like, ooh, well, maybe I'll get a double top or a lower high up there. Or maybe that's when you start to hedge your S&P 500 position. You see what I'm saying? Now, Russell says, I prefer to do top-down analysis from higher to lower. Absolutely. But what I'll do, Russell, is I'll start here on a 4-hour or a daily, and I will analyze it and say, okay, I want to buy it around 4,100, and I want to take it north to 4,300. It'll probably take me a week, maybe less. Okay? We call that strategy. Okay? Good. Good. That's strategy. So what was that? I want to buy it around 4,100. And I did say this before, non-farm payrolls. Okay, cool. So now what do we got? Okay. You can use a setup like this. Okay. That's a weekly pivot. And 4,100 is somewhere near that. And it changed direction on a 5-minute chart off of a pivot point. So the theory is you could have caught that. And you're like, Wayne, that chart looks like gobbledygook. All right, well, you could do it like this one. Okay, so what do you see here on a 1-minute chart? Resistance, resistance, all the way across. Resistance, right? You see all the support, support, okay? Support, support. But you remember, you want to buy somewhere around 4,100, huh? Now, can you see 4,100 as a buy here on a 1-minute chart? No. You got that on a 4-hour or a daily. So that's strategy. Now, tactics are to engage bullishly if the market flips to a bullish market somewhere around 4,100. And so we get down there 41 and a quarter, and you're just waiting for the price action, waiting for the price action, waiting for the price action. Higher high, higher low. Buy. That's it. Now you jam your stop and take a walk. 1-minute chart, ladies and germs. I'm not saying you should be smart enough to know that it's going to flip here. No. You do analysis, you create a strategy, you're a bull around 4,100, and that's when you want to buy. Gets down to 41 and a quarter, and then you wait, makes a higher high. This is when, by the way, FX bootcampers scream, hammock! And it has to do with the epic training people get at FX Bootcamp. They scream hammock, and they're ready, willing to engage higher lows. By the dip, let her rip. I want to move. Give me the juice. Okay? So that's how we do it, Russ. What else do you want me to cover in the last 10 minutes? Did you guys download all that fundamental analysis? I created the report today. I created the report today. It's as of this morning, about a half an hour before non-farm payrolls. You'll get the most updated report for the entire market, the most updated report for commitment as trader report, so you can see institutional and retail positioning, most updated for euro, dollar, pound dollar, Canadian, US Canadian dollar, Aussie dollar, Kiwi dollar, US Swiss franc dollar, Aussie yen, Euro yen, pound yen, Swissy yen, Kiwi yen, so on and so forth. S&P 500. Gold. It's all there, my friend. A couple other things. Did you click the thumbs up button or the like button on YouTube out of respect for FX Street and everything that they do for you? Thanks, Roja. Make sure you share some love, huh? See you, Stevie. Ooh, yeah, look at Natty. Rat-a-tat-tat-tat-a-tat like that. Okay. Little bull zone here on Bitcoin. If there are bulls, they need to enter. Yeah, ISIM can do it, Lucas. It's a good call on that one. Yeah, pretty amazing, huh? Oh, thank you. Lavelle says, hey, man, superbly done. Absolutely my pleasure. Okay, gold coming down. Remember, I believe we're in a deflationary period, and that makes sense to me. Okay. So now I could create a strategic plan that says up and sell around 1900. I actually created a plan like that 4 days ago. Okay. One of the things that people at FX Bootcamp learned recently is that I analyzed this market and I said around this period, gold would fall. That's what my analysis told me. And I didn't sell. Then, oh my God, I walked away around this period. I walked away, waited. Okay, then there's your double top. Now maybe a lower low, lower high. Now I have permission to engage if I so choose. But I had to wait. And where that leaves me now is my trade plan for next week would be have it come up to around 1900 and take it down to 1835. And if that happens, then I can engage. And that's where I drop into smaller time frames around 1900. So I could just say, all right, well, this is my selling price. Drop into a 15-minute chart and say, all right. So I put together a trade plan. It's cool, right? Isn't it pretty? Anything else going on? Okay, big pullback on my peso trade. So now what? What do I got? I have to be extremely careful. That is a double bottom. Oh my God. And we're on the daily sell. So I got to trap this. I got to update my chart here. Let me go further out weekly and update this. Let me delete that. And then I'll move this and delete that. Okay, go back into a smaller time frame. I know I already have a line there because I'm already aware of it, but I want to highlight it for all of us. I'm now in a range, and now I can move my stop. So I'll move it, move it, move it, move it, move it, move it. You see the pips there? I can lock in 10,000 pips. This is 10,000 pips right there. Oh, there we go. That's 10,000 pips. J-Man, it's not that I think Ethereum's going to drop to 900. It's an if-then statement. If the stock market drops another 20%, then it's going to take Ethereum down with it. So I don't know anything about Ethereum, but I know the correlations. So let's move this a little bit better. I'm going to lock in. There we go. It's not really good, but whatever. I've done enough. So again, J-Man, I'm a macroeconomist, so I have to look at things and say, how will the stock market and bond markets react to a headline number of 500,000 on NFP, but also revisions up, and up over the last 3 months? So we have a lot more employment and pressure on wages than we ever thought. How will the market react to that? Well, that depends. What's their interpretation of the data, and how do they think the Fed is going to respond? Okay, so then that might drive the stock market down. And if it drives the stock market down, it's going to drag Ethereum with it. Now, the next question is 5% down, 10% down, 30% down. Once again, your interpretation of the facts will lead to that. But there's always that if-then statement. Okay, so you have this situation of the expected return of a stock is equal to the risk-free, okay, plus, gotta get rid of that, plus the beta, okay, over the expected return of the market minus the risk-free rate of return. So two things are likely to happen. Okay? The market might interpret that the stock market, that interest rates or yields on the 10-year T-note rise because of the NFP. If that occurs, then when you do the math, the value of an asset will fall. Also, you might expect a relationship here where what if you thought the expected return for the S&P 500 would suddenly be negative? Well, that would also drop this down. Okay? So again, the expected return for an asset okay, is equal to the risk-free rate of return, yield on the 10-year T-note, plus the beta of the stock times the expected return minus the risk-free, which is your opportunity cost. How sensitive is this stock to your opportunity cost? And what do you give up by taking the risk? If it's a negative number, then your risk is higher than your reward. You might as well just take your risk-free rate of return. And that's it. 10 o'clock on the nose. Thank you, FX Street. Thank you, moderator. ISM 55. I think that's an improvement, isn't it, Lucas? ISM up. Okay, that's another one, right? That's another higher. Well, we did the analysis before the numbers came out, and that was great. So at least we chose. Now, did the subjective analysis tell us it was going to be twice as much? No, but up is reasonable. Almost certainly it's going to be revised down next month, so be careful about that. But hey, man, I love trading. I love money. I love gold. I love oil. I love commodities. I love stocks and stock markets. I love Forex. I love collecting yield and swap. I like scalping. I like spot trading. I like swing trading. I like position trading. I like carry trading. I like working with FX Street. And I like you. Consider joining FX Bootcamp. Consider opening an account at Trader's Way. Consider checking out, consider downloading the recent QuantBox report. And have a wonderful weekend. Remember, review your trades for the week, analyze your strengths and weaknesses, and come up with some, maybe one bullet point on things that you're going to improve on next week. Remember, you never improve unless you measure and reflect and adjust. So one more time, peace on earth. May the pips be with you. May your profits be above average, and I hope to see you real soon.